Perfect. Good evening, everyone. Hope everybody is doing well. And thank you for taking out time late evening to attend the conference call organized by Incred Wealth. So, in terms of market, as we speak, after great run-up in equity markets from the lows of March 2020, on account of easing monetary policy and balance sheet expansion by central banks, we are now entering a new regime where we'll see liquidity and rate normalization. So this will, in general, impact businesses as rates increase. Business environment will get tougher, and more emphasis will now be placed on companies which can deliver earnings growth going forward. So, in such an environment, it is essential to invest with managers who have the ability to pick up winners on a consistent basis. We are in conversation today with one such manager for their Unifi Blended Rangoli strategy. To throw more light on the markets going forward and the strategy, we have Mr. G. Maran today with us. To give a short introduction, he's been a market veteran. He's been in the market since the early 90s, instrumental in spearheading key initiatives for Unifi into niche segments and new geographies. He's been instrumental in managing key client relationships at Unifi as well. So with that, I'll hand it over to Maran for his thoughts on the markets and strategy. Thank you.
Thank you, Akshay. Thanks everyone for joining this evening. When I took advice from Akshay how to set this next 1 hour conversation format, he suggested to begin with our market views. And a few minutes back when he began the session, he gave some indications of how to look at markets, which I'm sure over the last few weeks to months, you would have heard several fund managers sharing their views, some optimistic, some very optimistic, some skeptical. But you will often find the rationalization of their views based on Fed, interest rate, quantitative easing, as if they determine the way markets move. We don't think so. Even before we share our views on what drives market and what drives equity valuations and how we have identified these opportunities over the last 20 years that we have been around in Unifi, and maybe 30 years around since I began investing. Even before I share my views, let's first do a quick review, what we call as housekeeping in understanding markets. When we say equity markets in India, most investors refer to Sensex, Nifty. Some of us refer to large cap, mid cap, small cap. Our market capitalization is about $3.6 trillion as of December 31st, 2020. Sixth largest stock market in the world. There are 1,900 companies that trade in NSE, many more in BSE. But the 30 companies in Sensex are worth about little more than half of India's market cap. The 50 companies in Nifty are almost 2/3 of India's market cap. And the top 100 companies, what we refer as large caps, are almost about 75–80% of India's market cap. So it's a very skewed market. In NSE, where you have 1,900 companies trading, the 50 companies in index are 2/3 of the total value. For example, this 3.6 trillion market cap. What is Reliance market cap? 230 billion. It's about 7-8%. What's TCS market? Same, another 7-8%. What is HDFC Bank market cap? Almost 100 billion, 70, 80, 100. It's another 6-7%. So 20-25% of India's market cap, 4 companies. So in a skewed market like ours, where just 30 companies in Sensex are half of the market cap, and 100 companies constitute almost 70-80% of the market cap. That's not a recent phenomenon. When we set up Unifi in 2001, this is a special year for us because we just completed 20 years since we set this up. In 2001, if you had taken top 100 companies, they were 83% of then prevailing market cap. In 2011, it was 81%, 2021, 75-80%. It hasn't changed in the last 20 years. And if you look at these 100 companies, which constitute 75-80% of India's market cap, what kind of companies are they? About 40% of Sensex, 40% of Nifty are all banking, financial services stocks. 15% IT, 14% consumer goods, almost 11-12% oil and gas, 10% plus pharma. So 70-80% of index are in just 5-6 sectors. They're not 70-80% of India's economy or corporate universe. So what I'm trying to communicate is, in a market as skewed as India, where hardly 50 companies constitute 2/3 of the market cap, the valuations of those 50 companies could be construed as valuation of the whole market. But whole market, broad market valuations could be different. But when we calculate weighted average, because few names, for example, I count about 70-75 people in this group. Each one's, if we want to calculate now the per capita net worth of each of us, maybe around 5 crores, 10 crores, 20 crores kind of number we may get. But if suddenly Mukesh Bhai comes and joins, then calculate weighted average net worth of each one of us, it will show $1 billion plus number. All of us are billionaires. It's wrong, right? So that's the challenge with weighted average. So when we describe market, we need to be conscious of the fact that our indices are skewed in favor of few large companies. And therefore, let's take BSE 500, or NSE 500, which includes all the 100 large caps, all the 150 mid caps, all the 250 small caps, which is anyway 95% of the investable universe. Today, if we take about 40% of the companies in this universe are trading at a PE multiple of 50 times or higher. That's where you will find companies like Asian Paints, Nestle, Bajaj Finance, Hindustan Lever, Titan, D-Mart, all the way up to 1,000 plus PE, Nykaa, so the weighted average PE of this universe in isolation is about 72. And these companies, last 1 year, last 3 years, last 5 years, earnings growth has been between 18 and 21% per annum. When you buy an equity, you are buying ownership interest in a business. If you own 100% stake in a business, all that business earnings is yours. If I come and join you as a partner and take 10% stake in the business, 10% of that business earnings is mine. If both of us go and list that stock and someone comes and buys one share in that company, you're getting earnings per share. If you look at equity as ownership interest in a business, what determines your return is that earnings as a percentage of the capital you, the price you paid, which is PE multiple. So if you pay 20 PE and buy a stock, and the company's earnings keep growing 20% per annum, as a shareholder, you will make 20% per annum. But same company, if someone comes and pays 40 PE, even if this company is earning continue to grow at same 20% per annum, that shareholder's future return as a percentage of the capital that he employed, the price that he paid, it's not going to be 20% per annum. Unless otherwise the earnings grow, his return is not going to be higher. If you pay 72 PE and buy the same stock, certainly we can say all the shareholders in all these companies, for example, today we build a portfolio of 1 lakh rupees each in all these 40% of the companies and hold 5 years, your cumulative return in the next 5 years is not going to be 20%, maybe 7-8%, because PEG that you pay 3 times, PE divided by the rate at which the earnings are growing. That's 40% of the market cap today. In the same market, exactly in the opposite side, about 25% of the market cap today are in companies whose PE multiples are below 14 times. The weighted average PE multiple of this universe is about 9 times. That's where you will find companies like Tata Steel, 5 PE, Steel Authority, 4 PE, State Bank, 9 PE, one of our own peer group, Motilal Oswal, 9 PE, TV Today, 8 PE, GNFC, GSFC, 6-7 PE, several companies. Why do they trade single-digit PE in a market which is otherwise seem to be expensive? Is you can put these companies in 2 kinds of categories. One kind could be companies like Tata Steel, Steel Authority, State Bank, whose earnings this year has grown 50-60% higher. Last year, 30-40% higher. But 7 out of last 10 years, they were loss-making. Their earnings are extremely cyclical. And therefore, no one knows how these earnings are likely to pan out a year or 2 from now. And therefore, even though price is cheap as a function of the earnings, because no one knows their future earnings, they are cheap. The other set of companies like Motilal, TV Today, may trade at single-digit PE, may look cheap. Their earnings have actually grown. This is a record year for them. Last year also is a record year. Their earnings has grown last 1 year, 3 years, 5 years. But their business is getting decimated by technology, tech-enabled app-based trading platforms, re-rating the brokerage industry, media industry. No one knows how these industries are going to evolve 3-5 years from now. So when you buy these stocks, you are buying for the future earnings and you don't have clarity of their future earnings. You can't put earnings estimates somewhere between -50 to +100%. You need to bring some range. That range is not visible. So price is cheap. And still people like us who otherwise call value investors are still looking at this from a distance. They're not jumping and buying. So that's 25% of the market. That leaves us with about 35% of the market, which trade somewhere around fair valuations. And here you have companies with significant leverage or companies with no leverage. You have companies with optimal single-digit earnings growth. You have companies growing 30-40%. Here is where people like us hunt for opportunities. So to describe markets in a homogeneous manner, that we are optimistic, bearish, we think markets will go so much or down, is may not be a logical thing to do, and we shy away from doing that. But people like us who otherwise have done maybe in the last 10 years 7 different strategies, but most of the strategies we raised capital in down markets. Whenever we raised capital, we would have raised limited capital, but in certain market functions. The reason why I use the word whenever we raise capital tells you that we don't raise capital throughout the period. For example, if I name a mutual fund or a regular PMS and I'm open 365 days a year, all the years, then you as an advisor or your client as an investor should decide when to invest, when not to invest, when to book profits, when to redeem completely. The fund manager's job is to beat the benchmark during the period you stayed invested, relatively perform better. In our case, our aspiration is not to beat any index or create alpha or relatively do better than other managers. Whenever we raise capital, we state an absolute rate of return, achieving which we close the fund, sell the stocks, return the money back, and get paid as share of profit. And since our focus is on the absolute return we generate, which we consider as our biggest strength, and we ignore the index completely, which means today we are raising capital, not believing that markets will do well in the next 3-5 years. Independent of what market does, we think our endeavor is to deliver 3 times in 5 years, which is 24% per annum. Do we guarantee? We don't. Then why are we indicating? We are casually indicating why not 4x, 5x, 6x, or 2x? Why only 3x? Which is what we said last year, which is what we said 3 years back, which is what we said 5 years back, which is what we said 8 years back, 10 years back. Did we achieve that? Okay. We have done 7 strategies in the last 10 years. In 5 of them, we have achieved that. In one, we came very close to that. In one, we were far away from. Maybe halfway through, maybe 100 did not reach 300, it reached 210, 220. That's our worst performing fund. So how is it possible to deliver 24% per annum over the last 3? Okay, last 1 year, 2 years is easy. How about last 3 years? People say it should have been easy. It's not. So if you ask people how much you think markets have gone up last 3 years, about 2 weeks back, Saturday, exactly maybe 10, 15 days back, I did a session with second year students of MBA in IIMs. Quite a few IIM students joined together. I do a session called Know Your Country. And if you are interested, you can type in YouTube and see some of these videos where we take them through our own, make them understand a little more about our own country. And when I asked this question, how much you think markets have gone up last 3 years? And most people's answer came somewhere between 100, 150, 180%. And this, since it happened just this month, which is January 2022, if you take December 18 to December 21, which is last 3 years, Sensex would have grown maybe about 65, 70%. Mid caps had grown even less than that. Small caps, maybe a little more than that. So all the 3 indices were somewhere between 60, 70, 75%. But why do we have that impression that indexes have gone up a lot? It's because what was 100 rupees in December 18? By March 20, in Sensex would have become 70. And by December 21, 70 would have become 170. So 70 becoming 170 where 100 is nominator and 70 is denominator may look like 150% rally in markets. But fact is 100 has become 170, which is 70% last 3 years. That's about 20% CAGR. Nothing great. How much do you think markets have gone up last 10 years? Maybe about 11, 12, 13%. It's not something abnormal. But the impression that we carry that markets have gone up last 2 years and most of it is liquidity driven may be globally relevant, but in Indian context, part of it could be true. But that liquidity, what liquidity it is? Is it coming from Fed money to FIS, or FIS money to India? Let's look at that. If you look at the shareholding pattern of Indian equities, this 3.6 trillion, who owns the stocks today? About 55% is owned by promoters, Indian promoters. About 20% is owned by FIIs. 13% is owned by domestic institutions, which include all mutual funds, UTI, LIC, private insurance companies, alternate investment funds. That's 13%. The non-institutional investors, which include retail, family offices, portfolio managers, you, me, your clients, my clients, that's 12%. So 55, 20, 13, 12 is how Indian listed equities are owned. The 55% promoters own may differ from company to company. But if you take large caps, almost 53% promoters own. If you take mid caps, 59% they own. If you take small cap, 57% they own, somewhat uniform. But the FII's ownership, which is 20% of India, but 1/3 of that is in 4 stocks, and 80% of that is in 50 stocks. So maybe in those 50 stocks, their influence is a lot. Therefore, indices move up and down depending on when they sell, buy. But rest of the markets, their influence is very, very marginal. What about DAIs? We may have 46 AMCs today, 273 equity schemes, 38 lakh crores total AUM, maybe 19, 20 lakh crores in equities. And if you take all the equities held by all these schemes of all the mutual fund houses, we'll again bring down back to the number that 80, 83% is in top 100 stocks, which is unavoidable in a market which is extremely skewed. And therefore, people like us who raise limited capital. What is limited capital? In the blend fund, first time we raised about 800 crores. Second time we wanted to raise 700 crores, but we raised only 650 crores. We couldn't raise more. Third time we launched 800 crores, we quickly raised. But what is the sanctity of this number, 500 crores, 600 crores? But the last new product we launched was called Insider Shadow Fund. We'll explain what that fund is in 2 minutes. But that fund we raised we raised only about 500 crores. But 7 years back, we did a fund called Holdco. We raised only 200 crores. Why different money? It's a function of the universe of ideas you are focusing on. What is the investable capital? Today, if I raise 800 crores and we invest that in 20 stocks, which means each stock 40, 50 crores, then even a company with 4,000-5,000 crores is liquid enough for us to consider. And India has 550 such companies. But if I raise 5,000, 10,000 crores, which is typically what some PMS and many mutual funds have done, that you invest in 20, 30 stocks, each stock then you should invest 300, 400 crores. If you call your dealing room and ask them that you have 5,000 crores to invest and you want to put them in 20, 30, 40 stocks, each stock 300 crores, and how many companies are there which you can buy 300 crores worth of stock, even if you take 1 week to buy, maybe about 70, 80 minutes. Okay. So when you grow large, your investment universe gets shrunk because markets is skewed. And even though we had this strength since 2001, why did we grow a lot in the last 5-6 years? And why many of us, we never had any institutional distribution till 2015-16. Not because we don't know how to deal with them, But because the kind of opportunities we pursue required only limited capital. If we had raised more capital, we could not have put in any of our strategies. Which is why till 2016, we never had any institutional distribution. And we ourselves were surprised with the growth that we have had since then because our investable universe has grown. For example, Insider Shadow, 500 crores that we raised, we deployed in within 3-4 months. But the first time we did Insider Shadow, we raised, I think, about 150 crores, and we took 3 months to deploy because the investment universe did not grow that much. And we had 3 strategies over 3 years, and then we had 7 over the next 5 years. Gives you a sense of opportunity. This Insider Shadow kind of opportunity, first time we did in 2008, second 2013, next to March 2020. Why March 2020? And why are we not raising money today? Is in March 2020, when markets fell 30% in India, not only India, globally, who are the biggest sellers? FIIs. But who bought the stocks when they sold? It's promoters. The number of companies promoters increased stake in 2020 is a 10-year high. And the value of shares promoters bought in 2020 was more than the previous 10 years. They are by nature contrarians. We have an interesting graph. Last 15 years, if you plot Sensex and Nifty, mid cap, small cap index, along with each quarter, number of companies promoters take went up, you will find an inverse correlation. For example, if you take last month, December, how many companies promoters increased stake? Hardly 2-3 new names. But how many companies promoters diluted stake? Some 27-28 new names. What is an IPO? Promoter dilution. How many IPOs last month? 26, 27. How many IPOs in March 2020? 0. But how many companies promoters increased stake in March 2020? 94. Okay. So if you are shadowing insiders, you will be raising a lot of capital in March 2020. But you should not be raising any capital in a year like last year, which is what we did. But in the last 15 years, if someone had bought 1 lakh rupees in every stock where promoters increased stake, how do you know? Just after the quarter is over, the companies announced shareholding pattern. So 21st of January, you would have got the list of companies where promoter stake went up in March, December quarter. And once you get that list, you buy 1 lakh rupees in every stock in that list without even knowing good company, bad company, large cap, mid cap, nothing. All you know is here is a list of companies where promoter stake went up. And you buy 1 lakh rupees each, hold 3 years, and then sell. And this current quarter will get over in March, and by 21st April, you have the list of companies, and you buy 1 lakh rupees in everything, and you hold 3 years and then sell. If someone had done that in the last 15 years, they would have made maybe a 23.5% CAGR. No fund manager has done that, including Unifi. But why is it very difficult to do? Is the assumption you are making is we buy when promoters buy. But promoters buy a lot in March 2020 and nothing in like December. That's what you and me can do as an investor, as a fund manager. It's not that all the companies where promoters stake would have grown 23.6. Actually, 11% of the cases you would have lost money. Even though promoters bought and you bought after they bought, still you would have lost capital. Maybe 16-17% of the cases you would have made single digit return. But 60-70% of the cases your IRR would have been between 25 and 40%. Which is what hopefully your return achieves. Like this, we have done about 7 different strategies. Strategies like India spin-off fund, where the whole fund invests only in companies which do demergers. There are many reasons why companies in multiple businesses demerge businesses separately to be independent. And many Indian companies which were built in 1960s, 70s, 80s, in absence of private equity, venture capital, no IPO market, banks were the principal form of financing, and almost all banks were nationalized till 1991. Many Indian promoters ended up doing new business as part of the existing company and ended up in multiple businesses in the same entity. And therefore, when markets begin to like focused businesses, they demerge, and that spin-off is what we were focusing on. We done that fund in 2010, 14, as well as 16. And then funds like Deep Value Fund, which is very conventional, orthodox, low PE investing, which we can't do in a market like today. So we haven't done. But in 2012-13, it was easy to identify companies growing 15, 20, 25%, zero debt balance sheets, trading at single-digit PE multiples. We have done few opportunistic funds also, like APJ20 in memory of Dr. Kalam in 2015-16, because a lot of market interest those days were in financial services, IT kind of business. And you could have bought a whole lot of chemicals and agri and mining and manufacturing businesses in 16-17 at throwaway prices. So this fund we did in 2016 with 5-year 3x mandate. And first year we did okay, average. Second year we did terribly, because in 2018 when mutual fund reorganization rule by SEBI came, many funds sold the stocks that we were holding, which was actually price decline. So we made minus 17-18% when index Sensex Nifty was plus 14, because we didn't have a single bank, we didn't have a single IT company, and those sectors were doing well. But 20% of our portfolio is specialty chemicals, and 11, 12, 14% of our portfolio were active pharmaceutical ingredients. And these are all companies which are doing well. The earnings were growing, but price didn't, because mutual funds were selling, which means PE declined. And that portfolio did 3x in 4th year. We didn't require 5 years to do that. And we have done funds like Holdco, Holding Companies Fund, which trade at significant discounts. The last major fund that we did that in 2018, was called BCAD, Business Consolidation After Disruption, where we buy the largest players in businesses which are extremely fragmented. And because of a disruption that happened in the sector or in the economy, those businesses, small margin regional guys, get decimated, and larger guys gain market share, and they tend to grow. When GST got implemented in 2017, replacing 26 different taxes that we had, we could clearly see that the impact of GST implementation was not uniform for all players in the same business. Small marginal regional guys get deeply impacted, and larger guys were gaining market share, which is why we did that fund in 2018. And we are actually relaunching that again, because COVID acted as a disruptor, and post-COVID, there were a lot of new insights, new data points to suggest how some portion of Indian consumption is breaking out in terms of explosive growth. This fund blend that we have been seeking capital now for, first time we did this about 5 years back in 2017. And since then till date, all the first maybe 100, 150 accounts, these first series accounts have already done 3x. We didn't require 5 years. Actually, we launched this in June 17, and they started doing 3x from last year, last quarter. The total weighted rate of return, if you take all the clients that came into the strategy, will be still little more than 26, which means at 24, you require 5 years to do 3x, at 26, before 5 years. The second series we did in 2018 end. Why 2018 immediately we did was, although we launched in 17, 2018, many of the mutual funds were selling stocks that we were holding, which means we wanted to buy, and we raised fresh capital, second round. And there are quite a few funds which were selling good quantity of small cap, mid caps, because they had mandatory to sell. That series did even better, maybe running between 31 to 32. That we did both in AAF and PMS farming. And AAF was a bit close-ended and PMS open-ended. And that fund has done maybe 31, 32 kind of IRR. Now that it's 2019, if you take January to 2021, in these 3 years, as I mentioned, best performing index would have done about 70%. And this fund would have done between 140, 150%. So how do you make double the index return? Is by ignoring the index. So this fund blend, third series that we do, it's a blend of best ideas that come from different themes we do. Why do we do blend in 2017? Why, even though we have been running since 2001, why we took 17 years to launch a fund like blend is we are actually very comfortable doing thematic allocation because it helps us to connect the right type of capital with the right type of investments. And many of the strategies that we do, while they sound a little exotic, many investors may find it difficult to comprehend some of the special themes because they may not move in correlation with index. There are some periods where a spin-off fund was moving opposite direction. Index would have been higher and our funds would have been lower. And sometimes there are certain periods where markets were range bound and spin-off even doubled. But if I'm doing, if you take, say, top 50 partners in KPMG, maybe 30, 32 of them would have personally committed their family capital to our spin-off fund. Because if majority of the demergers in India, accountants are them. And I need not explain the merit of investing in spin-offs to a partner in KPMG, or for that matter, and any audit partner. Similarly, when we did Insider Shadow Fund, it's very hard to explain what that fund is to someone outside India, because 55% ownership by promoters is unique to India. For example, US may have 52 trillion market cap. Only 6.5% is owned by promoters. 80% of the equities in the US are institutionally owned. Their ownership management is institutionalized. Executive management is independent board, which may or may not even hold stocks in the company. Whereas in India is the only major market out of the top 10 markets, which is dominant by promoters holding. And therefore, it is very important in India to observe what they are doing in stock. But for us to go and sell this idea to a promoter who is already doing a creeping acquisition on his own stock in the market, I need not to explain to him the merit of doing that, because he's already doing that. Maybe that's the reason if you take today top 200 promoters, removing public sectors, and many companies belong to the same promoter group. If you take the top 200 promoters, maybe about 37, 38 of these 200 have invested into that fund because they understand the merit. Similarly, Holdco, when we did, many of our own clients felt many of these holding companies traded significant discounts because of poor corporate governance, low disclosure standards, thinly traded stocks in market. But today, if you list down, say, top 10 marquee investors in India, some of them who don't come on televisions, who don't describe markets, who don't share their views, you may find 2-3 of them into that fund, including the multi-billionaire. So what I'm trying to say is, each different theme has a merit, and that merit can be of great importance and value to certain types of investors. But blend, because it is a blend of ideas coming from 6-7 different themes, it gets evened out and less volatile, and maybe more preferred by general investors. And that's why it evolved to become our major theme over this last 5 years. Today, out of about 11,700 crores that we manage, maybe little under half of that is in blend. But we don't have one model account, and every stock that comes in is done for every client. First series is different. Second series is different. The third series, which we have been building now for the last few months, you won't find any chemical stocks, because most of them have run up. And there's no point in investing in 50-60 PE, because, as I mentioned, 40% of the market is super expensive. And many of the older themes that we bought, which were nominal value, have become expensive, which we have exited, and therefore we don't want to buy. So there is significant changes. And also we don't, as I mentioned, no model accounts. So if someone opens the account 3 months back, we might have bought 20 stocks. And if there are 2-3 stocks which have run up, which we don't want to buy at current price, it may be with some other holdings. Because what determines our future income is the return that we generate for the investor from the time we invest. And that way, blend has evolved to become a mainstream fund. And that's what we are happy to introduce you to the InCred team. That's my introduction. We'll be happy to take questions from you. Thank you.
Thanks a lot, Maran. Thanks for the whole overview on the markets and your views. I'd request all participants to please type in their questions in the Q&A box at the bottom of the screen. I'll be able to then read it out to Maran and get his views on the same. Maran, first question is there could be phases of underperformance owing to focus on valuations. How do you tackle it? I think more hinted towards if you are in a deep value stock, which turns out to be a value trap, how do you tackle that?
See, deep value doesn't mean low PE, and vice versa. For example, Tata Steel at 5 PE, is it a deep value? According to us, no. Is ICICI Securities at 10 PE deep value? Yes. What is the difference? At the end of the day, if your portfolio has to grow 24%, which means share prices of the companies you hold should grow 24%, share price has two variables, earnings and PE multiple. E multiplied by P divided by E is equal to P. So if the share price has to grow, either earnings has to grow or PE multiple should grow. When you describe deep value as low PE, fine. But what about E? If the earnings don't grow, how much ever low PE you pay is low PE, that's fine. Where is the price growth if the earnings don't grow? And if the earnings become zero and forever remains zero, anything multiplied with zero is zero. So if you have earnings growth of say 20% and you get them at lower than 20 PE, then it is deep value, correct? And if it is 10 PE, it is deep value. If it is 20 PE, it's value. If the same stock you pay 72 PE, it's not value. It's not growth according to us, it's madness, stupidity. Maybe if you buy 30 PE, it can be considered as growth. So when we get trapped into some of these situations is the company's earnings are growing 20% and we should be buying them at 20 PE, but after we buy, if the earnings don't grow or earnings growth degrows, which means instead of growing 20%, they grow 10%, then will we make money? No, we will lose money. So when we are about a team of 100 people and the client management people are hardly about 10, 15 in terms of people who meet clients and soliciting capital or managing. So what the rest of the people do? 14-member research team. One thing we feel very happy and proud is the research team which does primary research. When it comes to primary research in India, if you take the top 50, 100 companies, you want a research report, you can get easily 30, 40, 50 analyst reports from 30, 40 different firms. But if you go beyond company number 150, 200, you may not find more than 2, 3 analyst tracking. If you go beyond company number 250, you may find several companies without any analyst coverage. The information asymmetry risk in India is much higher in small mid caps as compared to large caps. People confuse that with corporate governance risk. It's not that large caps have great governance and small caps have poor governance. You find corporate governance issues in large caps, in mid caps, in small caps. But information asymmetry may not be that much in a large cap. But it's a big issue in small caps, which means we need to do primary research, which means before we evaluate a stock, we should know the company, the customers, the vendors, suppliers, and if the company has 4 plants, we should have visited them. And you should do similar kind of research maybe in one another company, which is peer group competition. It takes time and money. The cost of research is inversely proportional to the size of the company. It may look weird, but it is a reality, right? For us to go on tomorrow do a research on a large cap Hero Motors may not take long time and may not cost much money because I can stand on shoulders of 40 analysts and see it slightly better. And company will have 20 people in investor relations to provide information as much as required. But that's not that's not the kind of time we will require if you want to buy a supplier of that company. And therefore, that research insight that we bring will help us in understanding the earnings cycle by understanding the company, the customers, the vendors, the suppliers, the competition. And in 1 or 2 cases, when we go wrong, we lose money. But with willingness to go wrong in 2, 3, we get the other 17, 18 stocks cheap. But if we want to build a portfolio where we should not go wrong even in one name, and then all the 20 stocks we may have to pay a premium, which at a portfolio level, the first one looks better for us. So to answer your question, deep values are not defined by the discount to cash or PE, the multiple we pay. The biggest trigger, there is no better catalyst in India other than the earnings growth. I can't find a company where the PE was low in the beginning and the earnings kept rising and price did not. Yeah.
Thanks, Maran. A few more questions. One on PSU banks. So PSU banks are selling at below book value. Do you foresee any action from the government in the coming budget?
We don't take speculative calls here. This is a speculative call. You wait for an event to happen, and if it happens, you are right. If it doesn't happen, you lose. There are people who have a mind frame for it, and we don't. And we usually shy away from taking any event. For example, spin-offs. Also, even though media writes about spin-offs, we get in only after the board of directors pass the resolution. And if a return expectation is 20-25%, there's no need to take many of these event risks. Some work, some won't. That doesn't usually gives a pleasant experience. So we avoid those situations.
Sure. Thanks, Maran. One more question would be on stock exits in the portfolio. So what are the parameters, or when do you typically exit a portfolio? One typically can be when a particular price target is met, but also touching on the other side, which could be maybe stocks not meeting expectations. So maybe some light on that.
Yeah. See, that's one great advantage if you are doing primary research. You know why you are buying, and therefore it will tell you when to sell. For example, if I'm buying because of our perception of the earnings growth, and if that earnings growth is going to come from, say, margin expansion, expansion in market, gaining market share, mostly return on equity and not financial leverage. And if that earnings growth is what I'm betting at a PE multiple, which is commensurate to that earnings growth, which means my PEG is 1. The company's earning growth 20%, and I buy 20 PE, and that 20% earning growth comes mostly from high return on equity and no leverage. If that is the framework in which we are buying, and if next year company's earning grow 20%, share price grows 20%, so we have no reason to sell. And the earnings grow 20%, but stock price goes 60%, we have a reason to sell because it's no more the PE in the range that we want. And if we have other ideas which are at much more attractive PE, then we should sell. But if the company's earnings, instead of growing 20, and if their earnings has grown 15, and then it will be evident every quarter when the companies announce results, we engage in a conversation with the company, and our conversation is not the exact EPS number. We may have a one para note on a company, but we may have 140 worksheets on the company. And when you have sensitive analysis put on the worksheets and you understand that your understanding of the business was wrong, it is not that the company was wrong, our understanding of business was wrong, then we get out. Or time to time, this is a constant exercise. Sometimes we come across new insights, new data points about company or the promoter or promoters' other interests other than the company, and that make your assumptions of capital efficiency wrong, then you exit. So if price is a function of earnings and PE, if the factors that determine your sell should be driven by one of these two, and earnings disappointments do happen because we are not buying businesses where the earnings are certain to grow. If you today want to buy companies where the earnings are certain to grow at this rate, then they are all available at 70, 80 PE. But if I'm buying companies whose earnings are growing, but they are not consistent, but their earning growth is dependent on 2-3 moving variables which are not clear, and therefore PE is low, we may still buy because maybe it is less clear to others, maybe more clear to us because we have done this homework, and we buy. And if we are proved wrong 3 months, 6 months later because the earning growth that we are betting on is not happening, then we are humble enough to accept that as a mistake and exit and move on. But in exchange for willingness, you get so many other names which are at PEG of 1, 1.5, which gives us an edge, because which is what over the last 10 years, if you had seen, whether market cycle is up, down, over a 3-year, 5-year period, at the end of the day, our portfolio return converges with the earning growth of the companies that we invest in. It may not converge every month, it may not converge every year, but it eventually converges over a 3 to 5 year period. The only fair thing you should do is you should not commit the mistake of overpaying for it. As long as we pay a PEG of 1, and if the earnings grow, we will make money. But if the earnings don't grow, we can't blame market for it. We should blame our own poor stock selection. So that way our exits are driven by factors which would have made us to initially look at that either from the earnings point of view or PE point of view. I asked this question to a very, very successful investor of India, probably one of the top 5 investor, who's very, very low profile, and I don't think many present day investors would have even seen his face. And when I asked the same question, how do you sell? Because there's been holding some stocks for 10, 20, 25 years, but some stocks he has been selling in within within the same year also. This is he'll sell either when the promoter gets drunk or when market gets drunk, which is what E and P. Promoter could get drunk either because business is growing and he does very poor acquisitions, or he leverages, or he makes mistakes in pricing and the earnings take a hit. Markets could get drunk either by assuming some 3-year earnings growth as if it is permanent and extrapolates and then discounts with the very low interest rates and discounting rate and give very high PE. And both could happen. And if one of these two happen, we exit.
Thanks, Maran. In the interest of time, I have three more questions. Maybe I'll ask those. Uh, what's the right market P for IT sector nifty companies? So typically large cap IT, but my guess is that it would be subjective depending on the stock. But maybe if you have a number or a view on this.
See, it is not that there is a defined number that this large cap should have this P, mid cap should have this P, small cap should have this P, or this sector should have P. P is a function of the earnings growth, the visibility of that earnings growth, and the cost it takes to get that earnings growth. Okay. And last one, which is a lot more relevant last 2 years, not so much in the past, is the cost of capital, which you are deploying to get that earnings growth. So if I'm a Unilever and I'm promoter of Hindustan Lever and my subsidiary business has been growing 18-20% per annum in terms of earnings, and the visibility of that growth in the next 5-10 years is visible highly, and I have control, and my capital cost globally is 1.5%, 2% per annum over a 10-20 year cycle, and even if I buy them at 2 PEG, I'm still going to make 12-13%. Could be the reason I pay 2 PEG, which means high P. But if I don't have visibility of the earnings growth in future, I may pay less P. So from that perspective, ITP should be 25 today, or what is the right P? 35, 25, or 15? Maybe if we are taking the same industry in 96, 97, when for 6 years the industry grew 40% per annum because low base, then their P multiple went up from 50 to 150. Aberration. But how much the industry grew between 2008 and 2013? Not even 5% in dollar terms. So what happened to the P? You shrunk from 30s to below 20s. People don't realize, it's very hard for them to realize, the same IT industry P multiple in 2013-14 was in 15s. What is the shareholder return during that period? Close to zero. Earnings kept growing, P had been falling. So the industry P undergoes a change, and what drives that change is earnings growth. But if the earnings growth becomes extremely seasonal, then P could be extremely seasonal. But if the earnings growth becomes more and more consistent, more and more seasonality, with the base growing, size of the company growing, you will get evened out, and therefore volatility will be less. And therefore, because that volatility is less, some of the larger IT companies will have higher PE, not because they are larger, but because of their larger base, the earnings volatility is less, therefore they deserve a higher PE. So that way, there is no one number to put that number, and what we are trading is more or less a fair price. I don't think it's super expensive, and I don't think it's cheap.
Thanks, Manan. One question on liquidity in small cap. So smaller cap names where promoter holding is higher and there's less of free float. Is there an exit difficulty that you see once you made, say, a 3x return on that?
So good question. See, the small cap liquidity, we usually spend 3 months, 6 months in buying, and we usually sell in half when we get it right. And when we get it wrong, we take 6 months and sell. Because this is one mistake which people commit now. For example, if you take calendar year 2021, January to December, When we began the year, more than half of our portfolio were in small caps. When we ended the year, not even 20% was small cap. So what has happened? If you take 2018, in 2018, calendar year 2018, Sensex and Nifty were up 14% and small cap index was minus 21 because of SEBI mutual fund regulations. Mutual funds are selling small caps. And that year, if you take our blend portfolio, almost 90-95% was small and mid caps. Were a contrary. Last year, when small mid caps went through the roof, we have been selling most of the specialty chemicals and those kind of stocks. And what did we do with that money? Went and invested in large cap 1 or 2 IT, large cap 1 or 2 banks. Why? Are we expecting them to triple in the next 5 years? Of course not. Can they generate at best 10, 12, 15%? Possible. Which is better than liquid fund, which is better than keeping the money idle. But why we keep a portion of the portfolio in those kind of stocks is because even though people agree that small mid caps are more volatile than large caps, when the price declines, say a large cap price declines 20%, you still can sell. Volumes decline maybe 20%, maybe volumes may go if the price falls 20%. But in small caps, it's not like that. When small cap stocks decline 20%, volumes could rise 90%. Last Monday is a great example. Last Monday, when markets fell, of course, large caps fell 3-4%, small caps fell 4-5%. But 900 out of 1,900 stocks were downward freeze. Only sellers, no buyers. So the next is a down cycle in small mid caps. Whatever we want to buy, we are buying only, instead of buying 5% of the portfolio that we stock, we are buying 2.5% balance. We are holding in maybe ICICI Bank, Axis Bank, and Wipros, where we are positive, but we are not expected to make 3x in 5 years. Will they decline if the markets decline? Of course, but not as much as what small mid caps will decline. But can I sell even if they decline? I can comfortably, but not small mid caps, which I want to buy. But if I have access to cash, when small mid caps decline, when there are sellers and not many buyers, and I have cash and I have mindset to buy, then I will get the price which I want, which is what you need to have a contrarian mindset and a strong mandate from your investors to take those kind of risks, which is what intent to be bestowed with, and which is what generates the return. So the risk in small mid caps is the liquidity will dry. Liquidity is cyclical. 52-week liquidity is a useless number to have because that's not daily average. Some small caps some days will have 500,000 shares volume. Some days won't have 5,000 shares volume. And usually you will find we are buyers and we take 3 months, 6 months in buying. And we usually sell it half an hour if you get it right, which means we'll be selling to a buyer. So it's also a learning over the last 20 years in a big spread. For example, specialty chemicals, maybe between 1,000 plus crores worth of stocks that we had. Did we sell on the rise or are we selling on the fall? We're selling on the rise, which means if the stock is 100 to 200 rupees rally, we'll be selling at 150, 160, 170, which is easier because there will be a lot of takers. But if I want to sell at 200 to 150 fall, it will be a lot challenge. So we never got trapped into, we have got trapped into those 1, 2, 3 out of these 20 stocks in the portfolio where we think we might have got it wrong and we realize a mistake. Sometimes mistakes in a bull market are not punished. But when we make mistakes and realize we made a mistake, but when we realize the mistake, it was a year like 2018, we get royally punished. But as long as you have the mindset to take those in the positive stride, and as long as you limit that into 2, 3 out of 20, the impact of the overall portfolio is not dramatic. But because you have that mindset in a market where you are not competing with the FIIs and DAIs, instead the price discovery mechanism in many of the small caps are by small investors, some retail investors, some big punters, and you have the institutional framework to pick the right names and you have the strong mind to be a contrarian, the price discovery mechanism can be very favorable to you. And that's what we pursue. I hope I answered the question.
Thanks, Maran. So in the interest of time, we'll take one last question, typically asking for your views. in two sectors particularly, which is one is the housing finance companies, and second is commodity super cycle. What do you feel about it, especially steel and other products? So if you have a view on these two sub segments, the questions related to that.
We actually, none of us in Unifi take a top-down approach in picking stocks here. It's not that we take a view on the country, we take a view on certain themes and look at certain sectors and then become bullish in those sectors and then pick companies within the sector, because as I mentioned, India is not a homogeneous market. There are only few sectors which are a bit more homogeneous, like IT. But steel is not, certainly. It gives an impression that all stocks move in tandem. They don't. Right? There are few guys in that industry in the peak of the cycle making all the money, may leverage and do an acquisition and destroy shareholders' money for the next 10 years. Someone that peak of the cycle may use the profit to pay back debt and steer through the next cycle exceptionally well. So there are two guys in the, for example, just take last, if you had asked me, are you bullish in stockbroking industry 3 years back, what would have been my answer? Yes, no, one of these two, right? And in the last 3 years, out of top 5 stockbroking firms, one guy has gone up 200%, two guys have declined 50%. So how do you take a sector view? So while it is important for fund managers and mutual funds to take a sectoral view, because they have to communicate sectors they are investing, overweighting, underweighting sectors they avoid, because their performance is measured in relation to an index. And if the index has 35% in financials and fund manager has 0 in financials, he has to rationalize why he doesn't have financial. If the index has 15% IT and the fund manager has 20% IT, he has to rationalize why he is buying. If he has only 10% in IT, he has to rationalize why he is underweight, why he chooses not to invest in those sectors. So he has to have a view on sectors, and we didn't have. We didn't have to justify why we don't have metals, why we don't have housing finance companies. We need to justify what we hold in very simple English to the investor, both in terms of earnings and PE of the business that we invest, which is the companies that we invest, not necessarily the sectors. Having said that, these two are not big sectors that we are currently invested in, and therefore we may not have any strong views to offer in this.
Thanks, Maran. I think in the interest of time, we'll conclude this session. If there are any further questions, we'll reach out to you on behalf of our clients. I'd like to thank everyone, all the clients who've come and heard us today. And thank you, Maran. Thank you, Dhaval, for coming over and sharing your thoughts.
Thank you very much. Sincerely appreciate your interest. Thanks for the opportunity. We have a wonderful team in Bombay, Delhi, Chennai, Bangalore, Hyderabad, Calcutta. We'll be happy to come see you, present to you. And our blend brochure also has an FAQ, which has most of the questions our other clients have asked, which you might have missed to ask. When you read from them, it may preempt. Nothing wrong in taking some time. Do this 1 or 2 exercise before you invest, because it's better to take time to invest, because what is important is the time frame of investment. Many of the strategies may not show any true color in 3 months, 6 months. Sometimes it may show negative divergences. Therefore, unless otherwise we have a 5-year view, many of these strategies are avoidable. So give us an opportunity, have a look at it, and give us an opportunity to elaborate and explain to you. And if it matches your risk tolerance and return expectations, it will be great to have a stock. Look forward. Thanks again for the opportunity.
Thanks a lot.
Thank you, Akshay. Bye.